asset is also one of the standard that you're going to come across in your exams, either as a full question or as addendum questions in any of the 7 questions that will be given to you in your exams if you are preparing for ICANN. So we are looking at it, and it's also, like I've said earlier, it's a very simple standard. All that you need to understand is what I will be telling you also in this class. So the overview of it is, you need to know what exactly is provision, what exactly is a contingent liability, and what exactly is our contingent assets. And with that, you are good to go, and then you can be able to deal with any questions that they are bringing your way. So quickly, let's run through what exactly it is talking about. 37 tells us how to deal with uncertain obligation. That is obligation with future uncertainty. How do you deal with them? You have obligation as an entity, and so how do you deal with them when they come your way? That's just the overview. Sometimes the company will have responsibility to, look at an amount that, they have not yet received, they're anticipating to receive, or they're anticipating to pay, like that. So the amount is yet to be received. The timing of the payment is not known, and that's why we call it a future uncertainty, as it were. And that is everything about provision. Also, when we talk about contingent liability and contingent asset, they are more or less like a situation whereby you have an obligation to also offset, but you are not certain what exactly is the total amount or the timing, as it were. You are not certain of what exactly is going to happen in the future, and so you know that you are going to settle it, or you are not certain rather that you will settle those obligations because it's not certain, and that's a contingent liability. Whereas contingent asset is, in the future you are expecting to receive something. Take for instance now, you have the tax authority now. They penalize your company and say that you have not paid tax. You appeal the tax. You are not certain whether the judgment will be in your favor or not. And so if it's not going to come in your favor, it will end up as a liability to you. And if it's going to come in your favor, it will become an asset to you. So all of these put together are 3-in-1 standard, talking about provisions, liability contingent, and asset contingent. So more or less, it's just like, how do you identify the uncertain obligations, the obligations of the future that you are not particularly certain how they are going to be, how exactly the amount will be, what the timing will be. That's just the overview. Everything about provision, contingent asset, and liability. So this standard actually helps the accountant, or helps us as financials, professionals, so we're able to know when to recognize that. This recognize provision, contingent. Well, you can't recognize contingent in your books. You can only recognize provision. So it helps us to know when to record that is recognized provisions in our book. How much to record, and then it explains all the financial disclosures that are required, as it were. And then the overview in general is this: provisions. You are to recognize provisions. You are to measure the amount, that is by estimation, as it were, and then you are to present it in the financial statement. Whereas the contingent liability as well as contingent asset, usually you are to disclose them in your notes to account, which is also known as a statement of policy. So let's go into this in detail, in full now. We look at provisions, we look at contingent liability, and we look at contingent asset. Also, we'll look at what we call onerous contract. Onerous contract can also exist that will give rise to provision. So we look at these 4 subheadings, and then I think we will be done with the class. So what are provisions? Provisions, they are like liability of uncertain timing, or an amount that is also not certain. So when we say provision is just like you are making, or you are creating something in your book You are not sure what the exact is, but you don't want to over carry your profit or under carry your profit, as it were. So you just have to make that provisions just in case it happens. That's how we call it a future uncertain amount that has to do with timing and an amount. So it is just like a money that the companies expect that you will have to pay in the future. You are not certain of the amount. You are also not certain of the exact time. So that is a provision. So it is like you making what we call a best judgment. You are using your best judgment approach in estimating exactly what the future cost will be to an entity. It's as simple as that. So it is more or less like a future cost that you are estimating based on your best judgment that the company or the entity will have to fulfill, as it were. So that is that for that. So let's look at the difference between provisions and other liability. Let's take a trade payable, for instance. Trade payable is a liability of certainty. You know that this person, you are owing the person. It is certain that you are owing, and you are sure that you will pay. That is certain. You bought a good, for instance, on credit for 100,000 naira. You know the exact figure, and you know what you have agreed when to pay. You have told them, please, this 100,000 I will pay between now and December. That is certain. Whereas provision, you are not certain. For instance, they sue your entity, and then you are expected to pay damages. You don't know if the judgment will go in your favor or not, but you have to make what is called a provision, that is estimate. If it happens that the thing did not come in my favor, this is the amount that I have already provided for in my profit for the year, and so it becomes a liability to you, as it were. So you are going to the what is it called? The accounting treatment is you will recognize it as an expense as well as recognize it as a liability. So you are debiting your profit or loss, and then you are crediting that you are crediting provisions under your liability. So it's very simple. That's everything about provision. It's not something that is difficult or hard, as it were. So it's a certain obligation, as it were. However, for you to recognize, let's go to recognition now. I've told you whenever we are looking at standard, we look at recognition, measurement, and we look at presentation and disclosure. For you to recognize provision, for you to say for you to be able to say that, okay, you are actually going to make an estimation, or you are actually going to make provision for an uncertain obligation, there are certain criteria that must be met. And that is where we have these recognitions in place. Please mute your mic so that we can hear ourselves. Thank you. So these recognition provisions are as follows. Number one, according to the IIS 7, there must be what we call a present obligation. That is, the company already owes something. That is, you have an obligation to fulfill because of your past event, because of your past activity. In other words, this present obligation simply means that it arising because of your past activity. That is, the business you were doing, the business you are into, the turnover of your asset, as it were, will give rise to it. That's why we say that it must have what we call a present obligation, and that present obligation will come from past event. That is past activity, past event, past activity. Now, for instance, if you are not into any business, for instance, an entity, it is not possible that an individual will sue you. That is that for that. And then also, it is not possible for somebody to just create an expectation from your company or from your entity, as it were, if you are not in business, if you are not trading. So that's why we say there must be what we call present obligation. And this present obligation could either be legal or constructive. It can be legal or constructive. It is legal when you are being sued as an entity. It is let me take that again. It is legal if you are being sued as an entity, and then it is constructive if your past activity is creating an expectations by your action. For instance, now, an environmental cleanup, maybe, for instance, where you are operating as a business, as an entity, you are messing up the place, and then you have made the place to be to be inhabitable as it were. For instance, we have this Shell and the Niger Delta people. They had issues a long time ago, and what brought about that issues were because of their environmental degradation, as it were. So now that can come. The people of that community, they told Shell, please, the way you are messing up our place, we will take you to court. Oh, that can bring about legal action. Now, if they did not take them to court, they approach them and say, look, come and do this thing, come and repair this place. And then, they will take it to Chief Palace or wherever the place is outside of the court, and then we agree this is what we are to do. That becomes a constructive present obligation. So the present obligation can come whether by law or by expectations from maybe your area of where you are operating, your area of operations, or from your clients and from your customers. So take note of that. That is number one. And then number two is the probability of the outflow of the resources. That there are some level of certainty that it will warrant that your resources will be depleted in offsetting the obligation. Take note of that. There is a high chance, more than 50%, that you are going to actually fulfill that obligation. If it is below 50%, that is the probability that there will be an outflow is not there. So number one criteria is there must be a present obligation. In other words, it will come from your activity, your past activity, what you have been doing before. The obligation will come from it. That's number one. Number two, the probability that you are going to pay must be above 50%. That is number two. And then number three, that's what we call reliable. The estimate must be reliable. The estimate you are making must be reliable. In other words, you are using best of judgment approach in estimating. However, your estimation must be close. If not 100%, it must be close to the amount that you are going to pay. Please take note of that. So I call it the PPR of provision. PPR. These are the three things that must be there. Very, very important. Three criteria or three conditions, as it were, that must be duly fulfilled before you can recognize provisions in your book. Please take note of that. It is not every past activity that will warrant you to have what we call future obligations of uncertainty. These three conditions must be fully met before you can say you are recognizing a provision in your book. Number one, there must be a present obligation. Present obligation means because of your past activity, you are becoming liable to make this payment. Number two, probability, that is, it must be highly probable, that is, more than 50%. It must be probable that you are going to pay that amount of money. If it's below 50%, measured, you can actually come up with the estimate. The reasonability of the must be more than 50%. So if it's not up to 50%, you cannot recognize it as provision. Rather, you are going to how this is done. So that is also measurement. How do you calculate it, as it were? So provisions are measured, like I told you earlier, by what we call best judgment or estimate approach, as it were. You are estimating it. It's an estimate. It will be a range of an amount. If not close to the exact, it will be, something that is almost close to that amount. Most likely to be the amount. And so that is that for that. So let's look at the example of provisions. So like I said, we look at the examples. Legal case. Let's begin with legal case. Remember I said they can be, your present obligation can be either legal or constructive. So let's look at this example. ABC Limited is being sued for 50 million.
I can't hear you again.
percent is around 70%. And if they should lose the case, they are going to pay around
Sir, please, your network is breaking. We can't hear
35
you.
million. The question we need to ask is this: is there a present obligation? Yes, of course, there is a present obligation because it is a lawsuit. Sorry, please. There is something that was omitted there. ABC Limited is being sued for 50 million by one of its customers. Sorry, please. And their lawyer, ABC lawyer now, ABC lawyer says it is probable, that is, there is 70% chance that the company will lose the case, and therefore they should expect that they will pay around 35 million naira. So the first thing is, once you see a
Sir, please, you're not sharing your screen again.
question, you should look at the recognition criteria. PPR is the condition. PPR. The first one is that present obligation must be available. Number two, there must be a high probability. There must be a probability that there will be an outflow that you are going to make that payment. Number three, you can reliably measure or estimate the amount that you pay. So from this question, we can see it here that ABC is being sued for 50 million by one of his customers. Their lawyer says the chances of the company losing is 70%, and then they are going to pay around 35 million. So looking at it one after the other.
Your screen is not showing again, no.
But
Hello, sir. We can't hear you. We can't see your screen. We are not following again.
apologies, please. I didn't know that I was off. Okay. Please.
You're welcome back, sir. Welcome back.
Just tell me where did we stop?
Sir, from the example
Legal case.
From the example one. Okay, thank you so much. So let me take it again. From the example one. Thank you. So we are looking at a legal case from the example one. This ABC Limited is being sued for 50 million by one of its customers. ABC is the entity. The customer is the one suing. And then ABC lawyer says there are 50% chances that the company will lose the case in the court. And therefore, if they lose the case, they are going to pay around 35 million naira. So you ask yourself, as the conditions for me to recognize this as provision, number one thing is there a present obligation? Remember, I said present obligation means you have been carrying out activity, trading activity over time. And so because of that, your trading activity, future uncertainty in terms of payments, for damages, for losses and the likes can arise. This is one of them. Is there a present obligation? Yes, there is, because it is one of their customers that took them to court. We don't know what transpired. Maybe the customer bought a fake product Maybe the customer bought an expired product. So anything can actually happen. And so therefore, the lawyer told them, ABCO, I will advise you. What I've seen so far, we don't have a case. I will advise you that we have 50%. There is a 70% chance of losing and 30% chance of winning. Therefore, if you're also losing, we are going to pay, there will be a whopping sum of 35 million to be paid. So is there a present obligation? Yes. Would there be an outflow of resources? Yes. How much? 35 million. What's the estimate? 35 million. Therefore, record provision. So all of these three conditions must be met before you can recognize provision. Please take note of that. So how do you treat it? I told you earlier that you are going to debit your profit or loss and credit your liability. So you debit your profit or loss with legal expense and credit your liability with provisions. Now, whether to be a long-term liability or short-term liability now will be in terms of the year. You understand now? But it's always advisable that you recognize your provision under, what is it called? Under your current liability. Now, in cases that involve, the court, that these legal cases now, if maybe you went to court the first hearing and I'm telling you that this case has been adjourned to the next 3 years or the next 2 years, you know that you can't carry that provision under your current liability. You are going to carry liability. We need that, Mola. Thank you. You understand that now? So that is that for that. So it's very simple. Let's take another example and under the constructive cases, warranty obligations. Now, I think this one will also have to do with constructive cases. Now, Deaf Electronics sells televisions with a 1-year warranty. This warranty is an obligation. 1-year warranty, as it were, is an obligation that it is expected for the company to fulfill to the customer, to the buyer. And based on past records, 5% of TV sold needs repair. In 2024, it sold 10,000 TV at 50,000 naira each. Expected repair cost per TV is 2,000 naira. In other words, I want us to look at this. Okay. In other words, it means that this company now, they have been able to discover that in their past records, every TV that they are selling, 5% of the TV will always need repairs. Will always need what? Repairs. And so because of that, they are making provisions that, okay, for any TV that is spoiled for us to repair, under our 1-year warranty, we are going to repair it for 2,000 naira. That is what we call future uncertainty. They are saying 5%. They are not certain it will be 5%. But of course, they are estimating about 5% of the TV to be spoiled. You understand now? So they have to make provision. This is a 1-year transaction now. So they have to make provision for that 1 year. Any TV that has our 1-year warranty that spoiled within 1 year, we have to make provision for it. Well, they have been able to estimate that, okay, if we are going to repair any TV that spoiled, it's 2,000 naira, we are going to repair it. Now, you have to ask yourself the question, is there an obligation, present obligation? Yes, there is. What is the obligation? They are selling TV to customer. This TV that they are selling to customer has 1-year warranty. Within that 1 year, any TV can get spoiled, and if it gets spoiled, customer has the right to bring it to us for repair. So there is what we call present obligation. Will it warrant transfer of resources? Yes, it will warrant. Why? Because once the TV got spoiled, there are possibility of you repairing it. Do you understand now? So there is what we call a high level of probability, because they have also estimated that 5% of the activity that they are selling by their past record, 5% actually gets spoiled. They have estimated that. And then they have also estimated the amount that they can use to do the repairs as it were. So is there a present obligation? Yes, there is. Is there the probability of outflow of resources? Yes, there is. Is the estimate reliably measured? Yes, we can measure it appropriately. Therefore, we have to recognize provision. So how do you measure it? The first thing first is how many units of TV do they expect to sell? They are starting to sell 10,000 TV, and the amount is 50,000 naira each. That does not concern you. If they are selling TV, they are selling 10,000 TV, and they are expecting 5% to be spoiled. 5% will need repair. So you have to, first of all, determine the 5% of the TV that will be repaired, and that will be 5% of 10,000. That will be 500 TV are expected to be repaired. And so at what amount do we repair each of the TV? 2,000 naira. So if you are repairing for 2,000 naira, it means the cost will now be 500 multiplied by 2,000, and that will be 1M all put together. So there is a provision of 1M warranty as it were. Thank you so much. Inen Ogbonna, you are on point. I'm giving you 1 mark for giving me the answer before I say it. I hope you did not look at my screen before you answer it. I'm sure you did not see it. So that is that for that. And you can see the treatment like I told you. You debit, what is it called? Warranty expense in your profit or loss. And then you credit provisions under your current liability because it's a 1-year warranty. The timing is stated 1-year warranty. And that does it for that. So quickly, let's go to contingent liability. I'm sure this is clear enough. And so therefore, you have any questions now before we move ahead? Okay, Benjamin, you are raising your hand.
Yes, sir. Good afternoon, sir. Good afternoon, everyone. Okay, so I have 2 questions. The first question is, please, sir, could you define in layman terms what we mean by this constructive obligation? Then secondly, again, after recognizing this provision in our books, what happens if the event eventually happened and the amount that we later incur was less than what we made provision for or was above it? How will the treatment be like?
Okay. Now, you see, let me begin with your last question. The essence of making provision is for an entity not to be caught unaware. That is number 1. Number 2 is for an entity not to overstate or understate their profit. That is, once you make profit, you are expected to declare the profit to the owners of the business. And also, so the owners of the business will not be feeling that you are not competent enough. That is why provisions have to be made for uncertain future expenses. Do you understand me now? Now, coming back to your first question, if, for instance, you make a provision of 30,000, and at the end of the day, you did not spend up to that, all that you need to do is to do what we call reversal. You recognize what you have recognized as an expense, you recognize as an income. You understand now? And then you are debiting back. You are not going, instead of you crediting the profit or loss, now you are going to instead of you debiting profit or loss, you are going to credit profit or loss. That is recognized as other income, and then you are debiting provisions for that over or under amount as it were. It's as simple as that in a layman way. Benjamin, is it understood? Is it clear? Thank you.
Yes, sir. Then the fourth question is constructive obligation.
Okay, constructive obligation. I told you earlier that a constructive obligation is any other obligation that is coming which it does not have to do with law, that is taking you to court, being sued. Just understand it that way. Any other obligation that comes in. For instance, I give an example of environmental cleanup, as it were. Now, let's look at this example. It's actually meant for those who are with the material to see, but let's look at it. Look at this example 4. Glory Bank PLC board decided to shut down 20 branches. Look at it. They decided to shut down 20 branches. They make that decision on the 28th of December 2024. It announces the closure to staff and the members of the public. Redundancy cost is going to be 12 million naira. Now look at it this way. This one now does not involve being sued in the court. So it is not legal. This is constructive. The question that you ask is there any past event? Yes, there is a past event. What is the past event? They actually have people, right? They actually have employees that have been working with them. They are now shutting down their branches. Some they will transfer, some they will lay off. Do you understand me now? So because now they announce that they are going to shut down those branches, because they announce that they are going to shut down those branches, it will mean that some of the staff will be laid off. Some of the members of the public may also lose their, certainly maybe some of their funds and the likes. And so you have to, since they have already announced to members of the public, that already makes it a constructive obligation, because they have announced to the public, we are going to shut down. That made them, you understand me now, to have what we call an obligation to all of the people, that the end users, and let me put it that way, those people that of course it will be affected. They have already announced it to them. So assuming they did not announce, you cannot recognize provision. But since they have announced, now let me say it that way, since they have announced it, it becomes an obligation on them to fulfill the terms and the condition of those future uncertainty. The timing of the payment we may not know, but of course, because they have announced it that, okay, we are shutting down our 20 branches, it means that they are going to shut it down whether they like it or not. They are shutting it down, and they've also told us that the cost, what they are going to spend, is 12 million naira. In this example now, is there a past event? Yes, there is. Is there a present obligation? Yes, there is. Will there be outflow of resources? Yes, there will be. Are we able to reliably measure the amount? Yes, we have, because we were told it's 12 million naira. So, Benjamin, whatsoever exactly it is that is outside of court cases, legal palaver, all of those ones are constructive. But please take note, it's very, very important for you to call it constructive. It must be something that is how will I put it now? That is, is certain. People can see it. You can read between the lines. It's very visible. It's not something that is done in the hidden. For instance, now some bank now they lay off their staff. We don't know. You can't tell me now I will make provisions for that, because some of the what is it called? Member of the public will not know, or what is it called now? Some of the staffs they may not know. Well, it depends on how they are also treating it in their own jurisdiction. So please take note of that. Whatsoever that is not legal in its own form is a constructive obligation. Thank you. So let's quickly go to contingent liability. What is a contingent liability? A contingent liability is what we call a maybe or a may or may not happen future events that will warrant you to pay a certain amount of money. In other words, it is a liability with a possible obligation. It may happen, it may not happen. So in a simple words, it is like a maybe debt. The company may have to pay it, or they may not pay it. But why you have issues is you are too sure that you are not too sure rather that there will be an outflow of your resources. That is, your asset will be depleted to offset that obligation. You understand me now? That's what we call liability. I give an example of a tax now. You were penalized by tax authority. And when they penalize you, you appeal. Now, in your appeal, you are not certain if, you are going to be refunded or you are even going to pay more. You don't know. So if you are now paying more, it becomes what we call a liability to you. You understand now? So, and if you are not going to pay, if you win rather in the appeal, it becomes an asset to you. So now, how you will know if it's a liability or an asset to you is when you're able to, engage what we call that probability approach. The probability that you will win If it's more than 50%, it becomes an asset to you. The probability of you losing, if it is there, it becomes a liability to you. So what are the key features? How do you identify a contingent liability? Number one, it must arise from past events. That's number one. It must arise from past events. Number two, the outcome of it will depend on future events. That is, you are not certain about it. That's why we call it contingent liability. Like the example I give now, the tax appeal that you make is because of your past event, because you are engaging in a business, you have filed your tax, and maybe tax authority now said, no, what you have filed or what you have paid is wrong. Pay this also amount of money. You understand? You now appeal. Upon your appeal, you don't know what will happen in the future, whether you are going to be the one to pay tax authority or tax authority that they will be the one to pay you. You understand now? So that's why we say it depends on future events. It depends on future events. So understand, number three, you are not going to record that liability in your books, but you are going to disclose it. You are going to disclose it. So these are the key features of contingent and liability. It arises from past event, with a future event not being certain, not fully certain, not fully under the controls of the company. The entity cannot do anything, but it is totally uncertain. You understand now? That's why we call it and it will involve, there's another, it will involve outflow of resources. That's why we call it contingent liability. It will involve outflow of resources. Assuming it will involve inflow of resources, it will become a contingent asset. Do you understand now? I'm sure you do. So let's go to how to treat contingent liability. I want to make it in a layman way.
Sir.
Go ahead.
Thank you so much, sir. I just want to make a clarification concerning this contingent liability. I'm on the road. I'm just listening to the lecture while I'm working. So, concerning to these contingent liabilities, supposing what you are trying to say now is that though the tax will be fined to pay the certain tax, and meanwhile the company has taken them to court. So while they are waiting for the outcome of the court, so they are going to pay the money being fined, that is the fine by the tax authority. Then after that, whatever the money being paid is contingent liability, while we are waiting for the outcome of the court case. So if it is favorable, that is asset, contingent asset. Or I just want to get the clarification very well, sir. Thank you.
Okay, it's not okay. See, let me explain it to you. If you can mute your mic.
Okay.
Now, understand this. When tax authority, when you file your tax, that's you pay the tax you felt you should pay to tax authority. Tax authority carry out what we call an assessment on you. And they say, look, what you have paid is lesser. This is the total amount you are supposed to pay. Look, take for instance, you pay 5 million naira. They did assessment on you. They say, no, you are supposed to pay 15 million naira. Go and pay 15 million naira. You have the right to appeal that 15 million naira. You understand now? You have the right to appeal. But usually, we always will advise clients to go and be making payments from that fine that they are giving to you. That is, if you are not too sure, if your books are not too sure. But if you know too well that your books are okay and you are confident that what tax authority have given to you is wrong and you are appealing it or it's not up to that amount, and you have every evidence and all of those records in place, and you go to appeal. Once you appeal, you are not going to recognize any that amount that they are giving you as a fine remains as a fine. You are not going to you are only going to disclose it in your book. But meanwhile, understand that what we are saying is this: that you have gone to appeal, you don't know what will happen, whether it will be in your favor or it will be against you. You understand me now? Sometimes also, as an entity, you may even file for appeal, knowing fully well that the appeal you are even filing, you know that your books are not correct, but you only want to delay or look for more time for you to be able to offset those obligations, it's certain that will be a future liability to you. You are certain. You are supposed to also disclose it that, okay, we have taken these people to, we have filed an appeal against the tax authority, disclose it and tell us, okay, this is the obligation they gave to us. This is what they are saying. This is where we are and the like. So what I'm explaining to you is this. Contingent liability is more or less like, an amount that you will pay in the future, but you are not certain if you are going to pay it. You understand? That's the difference between provision and contingent liability. Provisions now, you know that the amount you are going to pay. You are not certain about the amount. You understand? But you know too well that you are going to pay it. That is when it becomes provision. But where it becomes, there is an amount that you are going to pay, but you don't know how much it is, and you don't know when you are going to pay it. It becomes what we call contingent liability. That's just the basic and the major difference between the two. So understand this. When a divorce and outflow, and you can reliably measure the amount, that is, you can estimate what exactly the amount you are going to pay, it's a provision. You make provision for it. But when you are unable to, ascertain what the amount will be like, it becomes, but you know too well that it will be a liability to you in the future. You estimate it. I mean, you disclose it in your books as a contingent liability. You understand? Whereas contingent asset is you know that because of your past event, the amount will come into you. That is, there will be an inflow into you. That's what we call contingent asset. That is, you are not sure of when the amount will come to you, but you know that the amount will come to you. That's what we call a contingent asset. Do you understand it now, Owolafe? I'm sure you do.
Okay, thank you, sir. I understand it better, sir. Then one more thing, sir. Based on this provision, the provision you just explained, sir. Maybe, for example, we made a provision at the year end, the last month of the year. Say, for instance, the December. Meanwhile, the reporting date is 31st December of the year. And the such provision making, what we made the provision for, the obligation has not taken place till the following year. And if we want to report it, are we going to reverse it for that year and take it and start it in the next year, or we will recognize it in that December till when the obligation will be met? I think you understand my question, sir.
No, please come again with your question.
Okay, I said under the provision. So we have this PPR under the provision that there is a present obligations and there is probable of outflow of the resources and the reliable estimate, as what you said, based on what the standard required. Then now we now made the provision in December, and our reporting date is December of the year. And such provision now, we've credited our liability and debited our expense. So now for the year now, because we've not ascertained, because we've not paid the obligation, are we going to leave it in our book till when we pay that obligation that we made the provision for, or for that year we are going to recognize it and reverse it?
Okay, if I want, okay, based on what I think I understood from your question, I will say this: the reasons why we keep it in our current liability, you see, we expense it and we keep it in our current liability is for us to be able to pay within the next 1 year. You recognize it in the current financial year end. It is expected that before the next financial year end, you are going to make that payment. That was why the non-current liability. Are we still together?
Hello, sir.
Go ahead.
What I'm saying is, by recognizing it in that year, for instance,
Yes.
we are recognizing it in December of this year, and we've not paid the obligation. And according to that, means that we've we
You
understated
see,
our income because we've.
you see what, you don't get it wrong. You are making provision. It does not translate that
Yes.
you are paying it in that financial year. They call it
No,
provision.
sir.
That this.
I can
Go
hear you,
ahead.
sir. Go ahead, sir. I said, in this December, we've only, excuse me, in this December now, we've only made provision for it. I'm making
Yes.
that provision when the obligation has not taken place. So according to what you just explained earlier, that's why I'm trying to get the clarification on that. Okay,
When
in
the
this December
obligation,
now, because we've not. Okay, we
when the
only made the
obligation has not
provision
taken.
for it. Yeah, exactly, sir. So are
See,
we going to
look here.
reverse it when we are making the reporting?
No, hold on. Let me explain it better. Please mute your mic. Let me explain this
Okay.
thing better. Maybe you understand it. Mute your mic, please. There are conditions that must be met for you to create a provision. There are three conditions. The first one is that it must occur based on a past event. That is, you are making your provision based on past event, which can be either legal or constructive event, as it were. In other words, it's happening because of you are trading. Let me just put it in layman way, because you were into business. That's number one. Number two, we said the probability that you are going to offset that provision must be above 50%. And this must be highly probable. And that's why you are making that provision. If it is not probable, you cannot make provision for it. Please take note of that. If it is not probable, that is, the probability of you making that payment is not certain, you cannot make provision for it. That's number two. Number three, you must be able to estimate the amount that you are going to pay. Even if it's not 100%, it must be close to the 100% before you can say you are creating a provision in your book. Please take note of that. So now that in December you are making a provision, it means that you are foresee that in the coming financial year or in the subsequent financial year, you are certain that because of your past event, there is a possibility of you making a payment. You understand? A payment in the future. A payment in the future, and you can estimate the amount. That is only the time that you can create that provision. Do you understand it now? So, obligations of future uncertainty. You have an obligation to offset in the future. That's what we are referring to as you are making provisions for it. You have an obligation to offset. You are certain that you are going to offset it, and you can estimate the amount. That's when you create a provision. So if you are making that provision in December, you are not paying it that December. You are paying it in the next financial year or the subsequent financial year. So you're only making provision from the profit that you have for the current financial year. So it will not become a burden on you in the subsequent year, as it were. So once you make that payment, of course, you are going to reverse it. You understand me now? Into the current book as an expense. Do you understand it now?
Okay, now, yes, I get you right now. So that's what I wanted to clarify that, okay, we are going to carry it in this year, in the current year in our book as a recognition
Yes.
of the obligation. So, and we'll now
Yes.
take it over to the next year till when the obligation
So when you
will
now
finally
make the
paid.
payment, in that subsequent financial year, you recognize it as an expense there.
Thank you, sir.
All right.
Okay, thank you. Thank you, sir.
Sorry, I have a question, sir.
Please go ahead.
All right. My question is this. In the practical way, you are preparing, let's say, okay, we are preparing for 2025 financial report, that you are going to prepare in year 2026. So in your provision, is it obtainable or normal for you to make provision for your audit fee against year 2025 financial year that you are going to report in year 2026? Is it proper to prepare to make provision for audit fee?
Well, as an experienced person, I would tell you it's not proper, because It is an expense that you must make every year. You understand? So why are you making provision for it? So because it will happen in the financial year, you recognize in that financial year under your expense as a professional fee, and you charge your audit fee as it were. You charge it accordingly. So you don't need to make provision for it. And why are you making provision for it? But see, the thing there is this: some companies, they do some things because they are not guided. Do you understand me now? They are not adequately guided. You understand now? That's why tax authority now, if they come to check your books, they don't allow provisions. Because once you see some of the provisions are also that these people are also applying in the books are not correct, because they are using it to hide the profit, to reduce the profit, so they can reduce the taxes that they are paying. Why are you making provision for the audit that you know you will carry out that next year and you are going to pay? Why are you making provision for it? So if you are in the current financial year, you are the one, you know too well that they will audit your account for this financial year. You understand? And all that you need to do is pay them and recognize it, because they are going to audit your account. After all, the audit will take place and in the, what is it called now? In what is it called? Between let's say if your financial is December, so between January to June, it must take place.
May.
You understand? So between January to June, they must have completed it. So what is the essence of making provisions for that? The only thing there is this, you know, some of the companies, they believe that, okay, they are going to make that payment in the next financial year. They make provision for it this year. You are just wasting your time, because it does not amount to proper, to me, it's my own opinion, it does not appeal to me as a proper accounting, to me. But other persons may have their viewpoint, and I'm not condemning it in any way, but to me, it is not ideal. Are we good to go? Zara.
Hello, sir.
Hold on, Olaf. Let Zara ask question.
Good afternoon, sir.
Oga?
Yes, sir. I just want to comment on the question that exorbitant or asked now,
exorbitant.
Okay. So some company, I feel they try to spread the expense instead of the expense or that audit amount hitting their P&L just at once. Maybe the amount of the audit amount is let's say 30 million or 40 million. Instead of it hitting their P&L in that month, they try to provide for it before that period. They try to spread that expense across maybe 5 or 6 months so that it doesn't hit their P&L at once. I just feel that's why some company provide for audit fee.
Okay. I understand I will understand where we are all driving at, but let's not deviate from the class. But understand this in a real life context. According to the standard, if you go to IS1, the revenue you get in a year, you have to recognize it within that financial year. Is that not so? So what makes you not to recognize your expenses for that financial year, that same financial year? Why are you spreading it? Zara, do you understand where I'm driving at?
Yes,
some of
sir.
them are
Yes, sir.
spreading it just to hide the value of taxes that they are going to pay. That's just the main thing. There's nothing there. That's why you are becoming a professional, to also guide these entities and to tell them this is the correct way to do this thing. That's what if you go to the matching concept now, match revenue with the expenses for the period. Why are you spreading it? Why are you spreading it? Okay, George, please go ahead. I'll just take this one, then we move ahead so that we can have.
Hello,
good afternoon,
sir.
everyone.
Please, Olaf, just hold on. Let George ask his question.
Good afternoon, everyone. If I may chip in, most of the auditors too, they are engaged. So once you engage them, they also have their letter of how much you always pay them every year. So
Every
I think Yes. So as an accountant, you should be able to know how much you pay the auditors um, as at maybe
When
at the end
due.
of the year, you know what you paid. You are already paying them, so you don't need to make provision for that because you have already engaged them. They have their letter, how much you pay them every year.
Yes, you are correct. Thank you so much. All right, Olafe, go ahead. Your last question, and so we can quickly go to Olafe. Are you there? Okay, so I'm sure we all understood now. For contingent liability, you are always going to disclose it. You are not going to measure it because you don't know the amount that you are exactly going to pay. You understand me now? If you know the amount that you are to pay, it becomes, if you know the amount that you are to pay, and you know too well that you are going to pay it, and it's happening because of your past obligation, that becomes a provision and, and not a liability. But you know too well that you are going to make that payment, but you are not certain of the exact amount or the time that you are going to pay it. The probability of paying it is not also there. All that you need to do is to disclose it in your book. You are not going to recognize it as contingent liability in your books. There was an icon question I saw where they put contingent liability to test students, and that's why I'm emphasizing on this thing. Please be careful. Once you see contingent liability, know that it should appear in the, that's why you will see it in the notes of the account, additional information. You will not see it on the trial balance, as it were. Please note how to deal with it. It is to be disclosed. Take note of that. So let this thing that I want to mention now guide you. Let it guide you. Number one, you are going to recognize, you are going to classify a contingent liability as contingent liability when they follow in occur. Number one, there is a possible obligation. Look at it, not probable, only possible. That is, it may happen, it would happen, but you are not certain of the amount, you are not certain of the time. And then this is as a result of your present obligation, but the payment is not probable and the amount cannot be reliably estimated. I've said this thing over and over again. Please take note. The probability is less than 50. The amount you don't know. When you pay, you don't know, but you know that it's possible that you will pay. That is contingent liability. All that you need to do is to disclose. I'm begging you now, understand this thing. Thank you so much. Now, let's take a look at contingent asset. Okay, let's look at this example before we go to that contingent asset. Sunshine PSC issued 30 million, is sued for 30 million by a customer. The company lawyer says there is only a 30% chance the company will lose. 30% chance that the company will lose. Is there a present obligation? Yes, there is, because the customer is the one that sued them. Would there be an outflow of resources? No. Why? Because the chances is less than 50%. The chances is what? Is less than 50%. Estimates. They say 30 million. But since the chance is low, we don't know if they are going to pay. They say 30%. If it's 30%, it means that it's not certain that you are going to, you understand, as it were. So if it's 30% to lose, you know that there's a 70% to win. So there's no need for you to make a provision. Is that taken? Please always note this little thing. The chance is 30% to lose, meaning there is 70% of winning. So if you have 70% of winning, why are you making provision? Do you understand it now? So that's why we say once it's less than 50% chance, you don't need to recognize any provisions. Rather, you just disclose it in your book. We have a court case of 30 million naira by a customer. Our lawyer have advised us that we have 30% chance of losing. In other words, 70% chance of winning. Please, members of the public, take note. Simple. Fine country, Mary, please go ahead.
Okay, please, I wanted to ask a question on provisions. Maybe if you make a provision in your current accounting period, and at the end, when you actually make the payment you made is more than the provision you provided, you recognize. What would be the treatment, sir?
Your question is that you made a provision, let's assume, a provision of 30,000 naira, right? But at the end of the day, you are now paying 40,000 naira. Is that not so?
Exactly, sir.
Yes. What will happen is this: you have already made provision of 30,000. What will happen is this: you are going to debit that provision account with 30,000 naira, because now it is certain that this is the amount that you are going to pay. Remember, we said provisions are not sometimes exactly 100%, but it's always close to. So once you make provision and it's not up to, or the accounting treatment is, since you have made provision, that financial year that you are going to make the payment, you are going to debit the liability account, that is the provision account. You are going to debit it for that amount that you have provided for. Then the addition now that you are going to pay, which is the 10,000, you had it to hit. You will now expense it as a what is it called now? As a 40,000 for that current year.
Okay, sir, go ahead.
Okay, provision of 30,000. You are now paying 20,000. Is that also? That 20,000 that you have paid, you are going to pay, recognize the 20,000 as your expense for that in the subsequent financial year. And the 10,000 naira extra, you now take it to your profit or loss. Please give me 1 minute, just 1 minute. You want to ask a question? Please go ahead. I'm listening. Okay, go ahead. Is it clear now, Mary?
Yes, it's clear, sir.
Thank you so much. Please bring down your hands. We are okay now. So let's go to contingent assets. It's just the opposite of liability. But this one now, you are expecting an inflow. Liability is you are expecting to there will be an outflow, but you are not certain of when or the amount that is involved. It is the same thing with contingent asset. You are not certain of the amount that will come into you or when it will come to you. So a contingent asset is more or less like a potential economic benefit to you as an inflow, as an entity. But this benefit, hinges on certain conditions, some uncertain future events, some conditions of the future that are not certain. In other words, there are assets that arises, because of past event, but the existence will only be confirmed by future events. That is to say, that it will happen is a possibility, but the probability is not that certain. It may happen, it may not happen. It may happen, it may not happen. So you are not sure that the inflow will come to you 100%, that, or let's say above 50%. But somehow you have the the belief that maybe 30%, 40% in terms of probability gauge, you are to recognize it as a contingent asset. And then you're also going to disclose it. But there is something as a clause with a contingent asset. As a contingent asset, there is a clause there. And please take note of that clause. Very, very important. There is a clause. Now, if you are able to ascertain, that is the probability that that amount will come to you is like 50%, and you're able to estimate the amount. You're able to estimate the amount that will come. The standard said we should, recognize it as an actual asset in the statement of financial position. Before we get to that clause, let's take a look at some of the key things that will help us. The futures of contingent assets. They come from past event. Example, a lawsuit filed by a company against another company, against another entity, as it were. Their outcome depends on uncertain future events, like I've said. The winning in court case may be favorable, and the settlement will bring an additional benefit to you as an entity. I told you earlier, I said they are not to be recognized in financial statement because recognizing them may overstate your asset and mislead the users. They are to be disclosed. However, number 5, take note, this number 5, that's where I'm going to. If the inflow becomes virtually certain, that is almost guaranteed, that is, it is near 50%, you are a little being sure, virtually certain, almost guaranteed, then it will no longer be what we call contingent asset at that point. You are no longer going to recognize a contingent asset. Rather, you will recognize it as an actual asset in your statement of financial position. That's why I said there is a clause. There is a clause. You are only going to recognize it as a contingent asset. If you know that there are possibilities that if there will be inflows to you, there will be an inflow to you, but you are not certain of the amount, you are not certain of when, you have to recognize it as a contingent asset. But when you are virtually certain that it is almost looking as if the inflow will come to you, you are going to recognize it as an actual asset. And let me take a clue from the tax example that I gave earlier. For instance, that tax you have appealed, and from your books, you know too well that you are going to win. You are going to win. You have done, your own side of what is it called? Your own side of evaluation now, and then you arrive at what we call a temporary difference. That is, they did their own assessment, you did your own. Now there arises what we call a temporary difference. That is, the tax base now is higher than your own calculation. To what we call temporary difference. When we get to IS12, we'll look at all those ones. Now, with that temporary difference, there will be what we call a deferred tax asset. You are almost certain. That's why we say that one now you have done. They have done their own assessment. You are compared with your own books, and you have seen that what the assessment they have done, you are even supposed to pay lesser than the amount that you have paid. You understand me now? That will become. Let me not just go there because now I will be confusing you. Let me not confuse you there more. But once we get to IS12, I'm sure you understand it better. But understand is when you are virtually certain, you are too certain that that inflow will come to you. You are not going to recognize it as a contingent asset again. Rather, you will recognize it as an actual asset under the standard of financial position. And that is that for that. Any questions so far? I'm sure it is clear.
No, sir. Hello, sir. If you want to recognize this as an actual asset under the financial statement, what are we going to call it and under what category of asset? Thank you.
It will have a name now. It will be a PPE. It may be a PPE. It may be a non-current asset. It may be an intangible. It may be a non-current asset or a current asset. You understand me now? It may be a non-current asset. It may be, tangible asset or intangible asset. It may be under investment property. It depends on the nature and the types of the asset that is involved. You understand me now? Take for instance now, you sue a company, you sue a property company. Maybe you are into what is it called now? You are into investment. You understand? You are into investment as an entity. You invested in a property, and maybe somehow somebody, you know, what is it called now? Encroach into your land. You sue the person, and you know that you are going to win. You understand me now? The fine there, you are going to add it to a part of the what is it called now? You're going to add it to the part of the investment property, as it were. Do you understand? So it depends on the nature of the asset. Do you get it now, Olafe?
Thank you, sir.
All right. Any other question, please? So that is that for that. So let's look at the example. ABC Limited sue a competitor for 50 million for breach of contract. The company advises that there is a strong chance that 70% of winning this case. At this stage, the possible 50 million is a contingent asset because the inflow of the benefit depends on the court decision. Let me come again. They sued the competitor for 50 million. Is that not so? But the lawyers told us with evidence, everything that we have, we are going to win by 70%. So we are sure that this 50 million that we are seeking for may come to us. It's under probability. Let me use the word, the Wole Soyinka is under boyalty. Wole Soyinka says it's boyalty. So it's under boyalty now that this 50 million in total will come to us. You understand now? So as an entity, you are going to recognize this 50 million not in your book. You are going to disclose it in your book as a contingent asset. Why? Because the lawyer have advised that there are 70% chances of winning. However, you don't know when the court will sit, and you don't know the exact amount that is going to come to you. Do you understand now? Even if at the end of the day of disclosing as a contingent asset, you are disclosing as a contingent asset, when it comes to you, you recognize it in your book now. And that's when you recognize it in your book under the other asset, as it were. You recognize it in your book. It's as simple as that. Once you win the case, once the judge sees now, they now award you maybe the 50 million in total, they award it to you. You recognize it in your book. Hello, Rejoice, please. You are raising your hand. Go ahead.
Okay, good afternoon, sir. I think someone already asked the question. I wanted to clarify that what if the lawyers lose the case? Who is going to bear the final brunt of that information given by the lawyer that it's possible they're going to win with high chance of 70%?
Come again, please.
Okay, I wanted to ask that who are now going to like bear the final brunt at the end of the day if the company loses the case? Because the lawyer gave them that, oh, there's 70% chance that they are going to win the case. Then if they now lose at the end of the day, would the lawyer take responsibility for that misinformation or misjudgment?
Well, you know that I think the legal luminary, those are the people that will advise us on this one. Oh. But certainly, you know, for them to tell you there are 70% chance, they will have also done their, you know, their findings and the lies, as it were. But if you now turn at the end of the day that they now lose, that's why we say you should disclose. So the lawyer have misled them, as it were. And since the lawyer have misled them, of course, they may also take it up with the lawyer, as it were, and seek for damages. You understand that? So I'm not a legal person. I'm only a chartered accountant. So I already know what we do with that lawyer. Now maybe we'll have to go and consult a legal luminary to help us out in this case. But that's a good thought, actually. It's a good one, thinking that way. That's why you're a professional. So it's good that you think it out. But for a lawyer to advise that 70% of winning, I mean, they will have done their homework, and that said it all. Any other question, please?
All right, thank you, sir. My question now is that After they now win the case, though I don't know, you might have answered it, maybe I didn't get it clearly. After they now win the case, so how are we going to record the 50 million naira? Are we going to put it in our what's it called, non-current asset, or it's going to be under our what's it called?
It will be, see, look at it and let me explain it to you. If they now take the matter to court and you now win, and the judge award the 50 million naira to you, you don't expect that you will be paid immediately now. Is that not so? So you take it to your, what is it called, under your current asset as your receivable. You understand now? You will no longer recognize as a contingent asset. You take it to your receivable. You are expecting no receivable. They are going to pay us 50 million. We have won in court. You understand now?
Okay,
You understand it? All right. Any other question, please? Are we good to go? Okay. So that is that for that. Now let's go to the last one here, and that is what we call onerous contract. What is onerous contract? Onerous contract simply means an unavoidable cost of meeting an obligation you have already agreed to that exceeds the future economic benefit that you are going to receive from it. That is, you have entered into a contract to perform certain obligation. But when you now did the calculation of the cost, that is, what you are going to spend, it is now higher than the benefit, it becomes an onerous contract. Take, for instance, you enter a contract to supply 1,000 laptop, as it were, and install it. You know, you are not the seller, but you know, you have made contact and the likes. It says call I5, that is the amount they are selling it. You have already agreed. You are supplying 1,000. You have signed it. You are supplying. You are installing everything. 110,000 naira each for the 1,000 laptops. Somebody should help me multiply 1,000 by 120. That should be 12 million if I'm not mistaken. 1,000 multiplied by 120,000. That should be 12 million if I'm not mistaken. Now you have agreed.
120 million.
120 million. Thank you. Now we have agreed with the customer that you are going to do the supply. Everything has been sealed. They have even advanced you and the likes. In the course of you now procuring, or you are making, what is it called now? Call after you have agreed. You are making call to the company that I want to sell to you. They now tell you that, all right, the price has gone up. Oh, it is now 125,000 per one. Contract is contract. You have already signed it, and I don't think there is a clause on that contract that says you can review the price. You have already signed. It is being sealed. You are meant to supply it. It means that the cost, if they are not selling for 125,000 naira, please help me multiply. That will be 125 million naira. Meaning that the cost now is 125 million naira, and the benefit to you is 120,000 naira. There is a difference of 5 million naira. That 5 million naira, you have to make provision for it, that you are going to offset it in your profit in the next financial year. So that's what they call it, an onerous contract. An onerous contract is an unavoidable cost because you have to make the supply. You have already entered a contract. So it is more or less like a loss to you, but you are going to remove it from your profit in the subsequent financial year. So you are expected to make provision for it. So we also make provision for, onerous contract. That is the laws are obligation under zero. Please, can you hear me clear now?
Yes, sir.
No, you can hear me
Yes,
now?
sir.
Okay.
Your voice was
So come
breaking.
again, right?
You can come again, sir.
Okay, let me come again, please. Onerous contract
Yes, sir.
is a contract that arises. I mean, it's a loss, a net loss that arises when the cost of executing a contract is higher than the benefit that the entity will receive having entered into the contract. And according to IAS 37, once that cost is higher, the difference is to be recognized and provided for in the subsequent financial year. In other words, that net loss, you have to provide for it, that is to pay it out of your profit in the next financial year. Make provision for it to eliminate it in your next financial year. And I gave an example. You have entered a contract to supply 1,000 laptops, 120,000 naira, see, done and dusted. But when you have to go back to the market, they told you that it is now when you are supposed to make the supply, they say it's now 125,000 naira. 120,000 multiplied by 1,000 will give us 120 million. And then 125 by 1,000 naira will give us 125 million. In other words, 125 million is a cost. Is a cost to execute that contract. Whereas the benefit to you is 120,000 naira. So that 5 million naira difference becomes what we call a net loss on an onerous contract. So onerous contract simply means, the cost higher than the benefit. So once the cost is higher than the benefit, in a contract that we have agreed on, it becomes an onerous contract. And then you're expected to make provisions to cover that loss in your subsequent financial year. Is it clear enough? Any question? Okay. Rejoice, go ahead.
Okay, sir. For this onerous contracts, is it like those kind of payments where customers make advance payment for products? The company already received the money for the products already. Is it in cases like that?
Yes, it happens in such cases a lot. Yes. A lot, yes. Yeah, it happens a lot in such cases. And you have to execute because you have already entered into that contract. You have to perform it. You have already agreed. So you have to perform it. So in the process of you supplying those products now, for instance, you already know that you're already at a loss. So that your loss, you have to make provisions for it in the next financial year. So you are allowed to make provision for it according to IAS 37. Is that taken? Thank you. Please, is in the next financial year. You can't make provision for this current year now. You are only going to make provision for subsequent year. You don't make provision. Please take note. You don't make provision for current accounting year. You understand? You only make provision for subsequent accounting year. Please take note of that. So why we are saying that contract now, you have already recognized the revenue. You are allowed to carry that provision to the next year profit so that it will relieve you as it were. Please take note. All right, Mary, you are raising your hand. Go ahead.
Okay, sir. What if in the next financial year, maybe probably your business made a loss?
Did not do well.
Are you allowed to carry it in the yes? Are you allowed to carry it in the maybe in the
Yes.
subsequent financial year?
Well, the thing there is this: it will add to your loss, as it were. It's as simple as that. If you're unable to make a profit in that subsequent year, the provision will add to your loss. Do you understand now?
Yes, sir.
Thank you. Okay. Yes, this is where I want us to these key points to always remember. That's what I was actually looking for. These key points. Please take note of these key points. They are very, very important for you. Provision is not you saving money. It is you recording an obligation already expected that you are going to perform. Please take note. Provision is not that you are saving money for the future. You are only recording an obligation that is expected of you as an entity to perform in the future. That's number one. Number two, provisions are expensed in the profit or loss and as a liability in the statement of financial position. Why? Because it is expected to be nilled off at the point of execution. Once you execute the obligation, it will be nilled off from liability. Take note. For contingent liability, you are to disclose it. For contingent asset, you are not to record it, you are also to disclose it. And once the inflow is virtually certain, you are not going to recognize a contingent asset again, but rather it will be recognized as a direct asset in the statement of financial position. Please take note of that. It's very, very important. I think having said all of this, I'm sure we are well grounded now. Any question they are bringing on IS-37, you can deal with them. Any question?
Yeah. Thank you, sir.
Go ahead, please.
That number one out of the key points that you mentioned now, it's a provision is not saving money. It is recording an obligation already expected.
Yes,
so that
but
means
you are not performing it in this current financial year. You are performing the obligation in the subsequent financial year.
In the subsequent financial year. Okay, yes. I think this answer all the questions that we raised about audit fee and all that. It answered it.
Yeah, and this is your audit fee. Okay, let's look at the audit fee now.
Hello, sir.
Hold on, just hold on, please. Sorry, I will call you now. Now, look at it this way. The audit fee you are paying, are they going to audit the financial record of the subsequent financial year or the current financial year?
Thank you, sir. Majorly, like I use a practical example. After they prepare, for example, they prepare the year 2024 financial report in year 2025. Yes. So by the time they are doing the final compilation, instead of audit fee to be in pure L, it was stated in under the, I have one financial report in front of me as I'm talking to you right now. So they put it there, provision for audit fee. It was written there boldly under the, is it payable or something? Under our current liability. I'm trying to check it. So they put it there. They didn't put it in pure air. But while I'm preparing my own management account, I put it there. That okay, well, this is the amount we are going to pay. I put it there, like I the one we paid rather, and the remaining one I transfer it to payables. But they always, by the time they are doing their final report, they always put it there, provision for audit fees. Yeah, I can see. I can't pay that.
You know, let me explain to you why they are doing it that way.
All right, sir.
If we do not get our complete fee, you understand me now? If we do not get our complete fee, you cannot call it payable to you.
Yeah, I get you.
The reason is simple. You cannot call it a payable to you. It's a payable to you. Do you understand? But to us now, because your financials need to be clean. If you understand, your financials need to be clean. And if they are sometimes when you see that they are doing such kind of thing, they are also helping that entity. I mean, the public space now, there are certain things that I can't be saying. But maybe after the class, just come in and maybe we discuss about this. I mean, the public space, let me not say certain things that are not.
Okay.
Do you understand? Okay, but just understand that to you, it may be payable, but to them it's not payable. You have to make that provisions because you are now paying. You are unable to. You are, for instance, they are supposed to pay me 1 million naira full for my audit fee this year. You not pay me full because I have not executed the job completely. Is that not so? So you pay me less as 500,000 naira. That 500,000 naira is remaining now. You will want to carry it as payable. They will not want to agree that it's payable. Why? Because you are not going to pay them from this current financial year again. You are going to pay them in the subsequent financial year. So they expect that you should carry it as a provision in your book because it is a necessary obligation. You understand? So indirectly, you are still paying the 1 million this year from your profit. Do you understand it now? Indirectly, you are paying that 1 million naira in your current year. Why? Because you have paid me 500,000. You have recognized as audit fee. Provision now is 500. The 500,000 remaining is provision for audit fee. You are still going to debit your profit with it. Do you understand now? You get it now?
Yes.
And so
Yeah.
with that now, it means that you have paid the 1 million naira this current year. You are not going to pay it in the what is it called now? What is it called in the next financial year? Mary, please go ahead. Then please. After Mary, you ask your questions.
Okay, sir. Mine is just like an appeal to you to summarize the definition of provision, contingent, liability, and asset, so that when we are going through the record, it will be easy for us to differentiate between the three.
Do you have the material?
Items.
Buy the material. Is there in the material? Everything is there in the material. But I'll still summarize. So, Kwad, let me see your question.
Okay.
You haven't called me, sir.
Hey, sorry, Olaf. Just after Kwad, please. Go ahead.
Yeah. So my point is that this to my question is that the provision I want to ask about. Now, for example, like the audit you are giving an insight about now. So that means if you've not paid you said you pay 500,000. So that means can't we make provision for the 500,000 which you have not paid as an accrued expenses that we've not paid?
That's what I've just said now. You are making provision for it. So it is more or less as if you are reducing your profit without an exact 1 million that is due for the current financial year.
Okay. Thanks.
Right.
So what about the owner's contract that you explained earlier? So you said the excess, the owner's contract.
Yes.
The excess of, let's say we have a contract, but the budget with the price is collected now is lower than what we now use it for. We collect contract for 10 million. I think we now pay like 12 million. So the 2 million will be made for next year. But we make provision for it now.
Yes, you make provision for it now. You are expenses in next year, but you are making provision for it now.
Thank you, sir. Thank you.
Okay. Right. Olafe, please.
Oh, okay. Thank you, sir. I think you've explained what I wanted to ask, or I just want to add to what you've said concerning the what's it called, the audit field. And you've already explained it. I think there's no need again because I just wanted to buttress your point based on what we are practicing in my organization. So that is it, sir. Okay, thanks.
All right. Thank you so much, everyone. Any other question before we call it a day? Okay, so the material will be available for those who have paid. I think your drive will be updated shortly. And this video is the class is also well recorded and it will be deployed shortly. Thank you so much for your time.
Hello, sir, Mr. Ebenezer. Hello, sir. Are you there?
Yes, sir. Yes.
Okay. Thank you so much for the lecture. We appreciate you. Thank you, sir. And thank you so much, everyone, for joining. And please, we just want to remind you of what we just want to inform you that Next Gen Professional Associates, we are celebrating 1 year tomorrow, right? of course, it is based on achievements, and we'll forward the details to the platform. Thank you so much, everyone. We want to sincerely appreciate every one of you that have been sharing our flyers, our link, and all that, right? So we would not have been where we are today if not because of all your support, right? So we appreciate every one of you. Thank you so much, Mr. Ebenezer. Sir, do you have other thing to say, Mr. Ebenezer?
Well, what I would just say is this: it is our desire. It is not born out of pride. It is not born out of any other thing, but the desire to see more chartered accountants in the field of accounting. How can we have over 1 million accountants in Nigeria and we barely have 60,000 chartered accountants? We need more professionals. And that is the desires that we have. And that is what gives rise to our dream of holding this lecture free of charge so that we can bring in more chartered accountants. Please make the most of this opportunity. We are pleading with you. Make the most of it. And any question you have, please just come to the platform, ask us questions, we will attend to you. Thank you so much for your time. Indeed, I'm grateful that I can pass the little knowledge that I have with you. Thank you so much, everyone.
Thank you, sir. Thank you, sir.
Thank you, sir.
Please, thank you. Thank you, everyone.
Thank you, sir.